Ever since the release of ChatGPT in November of 2022, AI has been the hottest investment theme by far. As you probably already know, the single biggest beneficiary of the AI mania has been Nvidia. Nvidia's powerful GPUs are critical for training and operating so-called large language models like ChatGPT and many others. Over the past 3 years, Nvidia has seen its revenue and profits surge as tech companies order as many GPUs as they can get their hands on. With a market capitalization of $4.6 trillion, Nvidia is now the most valuable company in the world. And with a lofty price-to-earnings ratio of 54, investors seem to expect the already massive company to grow even more over the coming years. The bull case is that new AI applications will be released every year for the foreseeable future. This will create ever-increasing demand for Nvidia's GPUs. This is the consensus view on Wall Street, and Nvidia has become the world's most popular stock, as evidenced by its world's largest market cap. However, cracks are starting to show in the AI demand narrative. Over the past year or so, Nvidia has engaged in a complicated web of financial transactions with various of its customers. The single largest indirect consumer of Nvidia's GPUs is OpenAI. OpenAI spends tens of billions of dollars on computing services, mostly running on Nvidia GPUs. On September 22nd, Nvidia announced a strategic partnership with OpenAI. Under the partnership, Nvidia will make a $100 billion investment into OpenAI. OpenAI will use this money to build AI data centers. And what will those data centers be filled with? You guessed it, Nvidia GPUs. So Nvidia invests $100 billion into OpenAI. Some, if not most of this money will go back to Nvidia as OpenAI buys GPUs. This is called a round-trip investment. The current boom in AI stocks is eerily reminiscent of the dot-com bubble of the 1990s. The internet was indeed a major innovation, which eventually did revolutionize the global economy and society. But in the short term, investor hype got way out of hand, leading to malinvestment and bubbly valuations, ultimately leading to the dot-com crash in 2000. One of the biggest companies during the dot-com bubble was America Online, or AOL. By the late 1990s, AOL's revenue growth was slowing, so they resorted to round-tripping transactions where they would effectively pay their customers to advertise on their platform. In this video, we'll analyze the eerie similarities between Nvidia and AOL, and what this can tell us about the end demand for AI products. Prior to ChatGPT, Nvidia's data center segment generated approximately $3 billion of revenue per quarter. Starting in the second half of 2023, revenue began to skyrocket. Substantially all of this revenue increase can be attributed to AI. If we take Nvidia's data center revenue over the past 2 years and subtract the $3 billion quarterly baseline, we get $203 billion. So since the release of ChatGPT, Nvidia has sold $203 billion worth of GPUs that are used for AI. The vast majority of Nvidia's revenue comes from data center operators. These include the so-called hyperscalers, Microsoft, Google, Amazon, and Oracle, as well as newer companies like CoreWeave and Lambda Labs, which only do AI computing. These data center operators purchase Nvidia GPUs and then rent them out to AI startups. For example, OpenAI pays billions of dollars to Microsoft to use Microsoft's data centers, which are full of Nvidia GPUs. While the hyperscalers use some of the computing power internally, most of it goes to outside customers like OpenAI and the countless other AI startups that have popped up in recent years. The data center companies aren't really end customers. You can think of them as middlemen between Nvidia and the AI startups. This chart shows the capital expenditures of the 4 hyperscalers: Google, Microsoft, Amazon, and Oracle. We also included CoreWeave, which only does AI compute. Prior to the AI investment boom, these companies in aggregate spent about $30 billion per quarter in capital expenditures. Starting in late 2023, CapEx surged. This rise in CapEx is almost entirely related to building AI data centers. Most of the money goes to purchasing Nvidia's very expensive GPUs. If we look at the total CapEx over the past 2 years, minus the baseline, we can see that the cumulative AI-related spending has been approximately $190 billion. This corresponds very closely with the amount of revenue Nvidia has recognized. Meta is also a very large purchaser of Nvidia GPUs, but they're not a cloud service provider. They're kind of in their own category, so we didn't include them in the chart. For Nvidia to justify its massive valuation, they need the hyperscalers to not only maintain their very high level of capital expenditures, but actually increase their expenditures even further. But how sustainable is this? Many commentators talk about the massive world-changing potential of artificial intelligence. But to date, this has largely failed to materialize, at least when we look at how much revenue AI startups are generating. According to The Information, the top 20 AI startups combined generated an annual run rate of approximately $15 billion of revenue as of the summer of 2025. About $10 billion of that is OpenAI, $3-ish billion is Anthropic, and there are a bunch of smaller ones. While $15 billion might sound like a lot of money, it's actually pretty minuscule compared to the scale of AI investments. In the first 3 quarters of 2025, Nvidia sold $116 billion worth of data center GPUs. For the full year, they'll probably sell close to $180 billion worth. All AI startups are currently losing money. According to recent reporting by Bloomberg, OpenAI expects to generate $12.7 billion of revenue in 2025, but they expect to lose money. OpenAI's internal projections don't see them generating positive free cash flow until 2029. OpenAI is the largest and most successful AI startup by far, and even they expect to lose money for years to come. As GPU technology advances, it becomes cheaper to run any given AI model, but there's a constant arms race between the various AI startups. As soon as compute becomes cheaper, the AI startups make larger and more complicated models, which end up costing even more to operate. OpenAI offers 3 different tiers of ChatGPT to consumers. There's a free tier. They obviously lose money on the free tier. There's a plus tier which costs $20 per month, and a pro tier which costs $200 per month. You'd think they should at least make a profit on the pro tier because it's so expensive. You would be wrong. According to Sam Altman, they lose money even on the pro tier. The only people who are willing to pay for the pro tier are power users who use it so intensely that the computational cost OpenAI incurs is greater than $200 per month. The losses are funded by venture capital investment. Since 2023, OpenAI alone has raised $61 billion. In the first 9 months of 2025, AI startups in aggregate have raised $193 billion of venture capital. According to the venture capital firm Andreessen Horowitz, some AI startups spend more than 80% of their capital raised on compute resources. 80% is only in extreme cases. Nonetheless, a very large percentage of the venture capital invested in AI startups goes to computing costs. This money ultimately trickles up to Nvidia. Let's make some rough estimates of the AI ecosystem in 2025. All AI startups combined are expected to generate approximately $15 billion of revenue. This money comes from the end users of AI. By September, venture capitalists had already invested $193 billion into AI startups. By the end of the year, this might increase to $250 billion. Some AI startups spend more than 80% of their capital on compute. Let's say on average, half of the venture capital money goes to compute. This is revenue for the hyperscalers. Nvidia is probably on track to sell approximately $160 billion worth of data center GPUs this year. Nvidia makes huge profits. The hyperscalers also make profits. The amount of money they spend on Nvidia GPUs is probably greater than the revenue they'll generate this year. But the GPUs are capital investments that depreciate over multiple years, so the hyperscalers are making positive accounting profits. The problem is, AI startups are incurring huge losses. The revenue they generate from end users is a tiny fraction of what they spend on compute. The vast majority of the money comes from venture capital. The entire AI ecosystem is being propped up by hundreds of billions of dollars of venture capital. But what happens when the venture capitalists run out of money? While the venture capitalists might eventually run out of money, one company that still has a lot of cash is Nvidia. Over the past year, Nvidia has made a series of investments and transactions that raise eyebrows. One of Nvidia's biggest customers is CoreWeave. CoreWeave operates data centers full of Nvidia GPUs. CoreWeave rents these GPUs to customers including OpenAI. Building AI data centers requires massive upfront investments. CoreWeave buys billions of dollars of Nvidia GPUs. They hope to make back this investment over the following years. To fund these investments, CoreWeave takes out loans. They currently have approximately $11 billion of debt. Lending money to a company like CoreWeave is risky. What if a few years from now AI demand falls? Or maybe CoreWeave's GPUs become obsolete and customers don't want to rent them anymore. They may be put in a situation where their profits decline and they can't pay back their loans. Because of these risks, there's a limit to how much money banks are willing to lend to CoreWeave. In September of 2025, Nvidia signed a deal with CoreWeave. If at any point between now and 2032, CoreWeave ever faces a shortfall in demand, Nvidia will purchase its excess capacity up to $6.3 billion. What Nvidia would do with that computing capacity is unclear. This is a great thing for CoreWeave. It greatly de-risks their business going forward. Because of this, banks will be willing to lend them more money. They'll use that money to buy even more GPUs. To understand just how strange this deal is, let's apply this logic to a different industry. Let's imagine that you want to become an Uber driver, but you don't have a car. You don't have enough money to buy a car, so you'll have to finance it. You go to the car dealership. You talk to the salesman. You're worried there won't be enough demand on Uber and you might not make enough money to cover the car payments. The salesman says, "Don't worry. If you ever don't have enough rides on Uber, you can come to us. We'll pay you to drive our employees to and from work. Because we're giving you this guarantee, you're sure to be approved for the car loan." This is crazy. No car dealership would ever offer such a deal. And if they did, you'd probably think they're desperate. They're having trouble selling cars, so they have to offer this bizarre incentive. This is basically what Nvidia is doing for CoreWeave. Also, in September of 2025, Nvidia signed another strange deal with one of its customers. The customer is Lambda Labs. Lambda Labs is an AI data center company. They're basically a smaller version of CoreWeave. Nvidia agreed to pay $1.5 billion to Lambda to lease its GPUs. So Nvidia sold GPUs to Lambda and is now paying Lambda to lease them back. As a result of this deal, Nvidia will become Lambda's biggest customer. Nvidia says it's renting these GPUs for its own internal research purposes. It's not clear what they need so much computing power for. Nvidia does not develop its own large language AI models. Of the money that Nvidia is paying to Lambda, a large portion of it will likely be used by Lambda to purchase more Nvidia GPUs. So again, we can see a circular relationship. Lambda is a customer of Nvidia, and Nvidia is also a customer of Lambda. The biggest round-tripping deal by far is a recently announced partnership with OpenAI. OpenAI plans to deploy 10 gigawatts of Nvidia GPUs over the coming years to train and run new AI models. Nvidia intends to invest up to $100 billion in OpenAI as the new Nvidia systems are deployed. So $100 billion goes from Nvidia's bank account to OpenAI's bank account. This same cash will then go back to Nvidia's bank account. There are a couple of reasons why this is concerning. As we talked about earlier, Nvidia needs to continue growing its revenue to justify its massive stock market valuation. At least in the short term, end demand for AI is not nearly enough to pay for all the GPUs that Nvidia is selling. Thus far, venture capital has made up the difference. Now Nvidia probably fears there's not enough venture capital money to meet Wall Street's bullish projections for GPU sales. So Nvidia is using its own money to stimulate demand. They're spending billions of dollars to purchase computing capacity for their own internal research projects. What type of internal research could Nvidia possibly be doing that requires so much compute? It doesn't make a lot of sense. And then there's the $100 billion round-trip investment in OpenAI. $100 billion is a massive amount of money, even for Nvidia. Maybe Nvidia just thinks OpenAI is a good investment. They want to buy shares of OpenAI because they think the value will increase over time. The problem is, OpenAI's valuation has ballooned to a level that is far out of proportion to the amount of revenue it currently generates. In October of 2025, a secondary offering valued the company at $500 billion. This year, the company only expects to make $12.7 billion of revenue. That's a price-to-sales multiple of 39 times. And remember, this company is losing money and expects to continue losing money for years to come. Now they're going to spend $100 billion to make new AI data centers. That's just the cost to build the data centers. There will also be massive ongoing costs to supply electricity to the data centers. For this project to generate a positive ROI, OpenAI will need to generate hundreds of billions of dollars of revenue over the coming years. The bulls will argue that OpenAI's revenue will increase as they make new innovations and bring to market ever more sophisticated AI tools. No doubt this is true. But will the revenue increase fast enough to justify the massive investments being made today? The current AI boom has many similarities to the dot-com bubble of the 1990s. At the beginning of the video, we made a comparison between Nvidia and AOL. AOL was one of the most valuable dot-com companies of the day. When demand slowed down, they resorted to round-trip investments to inflate their reported revenue. If you want to learn more about the AOL story, we made a video about it a couple years ago, link in the description below. But the comparison between Nvidia and AOL is not perfect. A better comparison is probably the broadband infrastructure companies. The reason Nvidia is such a popular investment today is because they provide the vital infrastructure for the AI industry. No matter which AI startups eventually become successful, they will all need to use Nvidia's GPUs. During the dot-com bubble, a lot of people had this same logic. There were hundreds of dot-com companies. A few of them, like Amazon, eventually became massively successful, but the vast majority of them failed. A priori, it was very difficult to differentiate the Amazons from the pets.coms. So instead of investing in the dot-com companies themselves, a much safer bet was to invest in the broadband infrastructure companies. So long as the internet as a whole grows, there will be ever-increasing demand for broadband. One of the most successful broadband companies in the 1990s was called Global Crossing. Global Crossing specialized in deploying massive undersea internet cables that connected different continents, hence the name Global Crossing. These cables were expensive to deploy, and Global Crossing borrowed billions of dollars to fund these cables. Their share price peaked in 1998, giving the company a market capitalization of approximately $50 billion. While that doesn't sound huge by today's standards, it was a very large market cap at the time. Throughout the 1990s, internet adoption indeed increased rapidly. Broadband companies such as Global Crossing saw their revenue and profits surge. Everything appears to be going well. By the late 1990s, internet demand was still growing, but not as quickly as Global Crossing had expected. To meet Wall Street's ever-increasing expectations, the company resorted to accounting manipulations. By this point, Global Crossing and other broadband companies had laid far more undersea cables than there was demand for. The cables were underutilized, so Global Crossing engaged in so-called capacity swaps with other broadband companies. Let's suppose Global Crossing had a cable from New York to London. A different company called Qwest has a cable from San Francisco to Tokyo. Global Crossing sells Qwest the rights to use its New York to London line for $100 million. But Qwest doesn't pay for this in cash. They instead do a trade. Qwest gives Global Crossing the right to use $100 million worth of capacity on its San Francisco to Tokyo line. Both companies recognize $100 million of revenue. They can recognize this revenue regardless of how much demand there is from end consumers. Even if both cables remain underutilized, they can both recognize the revenue because they sold the capacity to each other. These capacity swap deals allowed Global Crossing to inflate its reported revenue and achieve a massive stock market valuation. But the revenue was kind of fake because they weren't being paid in cash. A few years later, Global Crossing imploded. They didn't have enough cash to service their debt and they went bankrupt in 2003. The exact mechanics of their accounting shenanigans aren't important. It's more important to understand the broad concept. End demand for internet service was not growing as quickly as expected. Global Crossing engaged in complex transactions, which allowed it to recognize revenue far in excess of consumer demand. Nvidia's $100 billion deal with OpenAI is very similar. Over the coming years, OpenAI will spend $100 billion to buy Nvidia GPUs. OpenAI can always consume an unlimited amount of computing power. They can always build larger and more computationally intensive AI models. They can do this regardless of whether or not consumers are willing to pay commensurately high prices to use these models. OpenAI can spend $100 billion to build new AI models. Maybe consumers are only willing to pay $10 billion to use these models. Nvidia will still receive $100 billion of revenue from OpenAI. But that cash originally came from Nvidia's bank account in the first place. It's like taking money out of your left pocket and putting it into your right pocket. The money is moving around in circles. People see the amazing things that AI is capable of doing. They think, wow, this is really cool. This will eventually create trillions of dollars of economic value. So it must be a good investment. The internet was far more revolutionary than AI can ever hope to be. Just ask yourself, would you rather give up your ability to use the internet or give up your ability to use AI? Of course you'd rather give up AI. Without the internet, you wouldn't even be able to use AI because all the AI applications are accessed via the internet. The internet was indeed revolutionary and eventually did create an almost unimaginable amount of economic value. Despite this, the dot-com boom was indeed a bubble that inevitably burst. The parallels between the AI boom of today and the dot-com bubble are so clear that you'd have to be blind not to see them. Alright guys, that wraps it up for this video. What do you think about Nvidia's round-tripping transactions? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.